Liz, I want to pick up there on the Fed. We do have that big meeting this week. Alan Blinder, of course, former vice chairman of the Fed, Liz, he had an editorial in the Journal saying the Fed should cut interest rates this week, Liz. What do you make of that?
Well, right now, the market thinks there's a 4% chance of the Fed cutting interest rates this week. And I don't think that Jerome Powell likes to surprise markets that much. So I would be shocked if they cut rates this week. I still think September is the first cut. There is chatter now about September being possibly a 50 basis point cut. I still view that as a very contrarian view. But we have a lot of data that we're going to get between now and that September 18th meeting. So we obviously have jobs coming this Friday. I think that's a very important number. And then in August, we have more CPI data. We have more PCE data. We have more jobs data. So we're going to get a decent amount of data before they have to make that rate cut decision, whether it's 25 basis points or 50 basis points. And we're going to hear from Powell, obviously, this week. We're going to hear from him again at Jackson Hole. So there are a couple opportunities for the Fed to shift their own commentary to become more dovish if the data warrants that.
Liz, I don't know if Jay's going to be quoting some 80s sitcoms like you did in your recent note, but we enjoyed some of your references there. But as you ask, who's the boss? Of course, one of everyone's favorites from that era. And you talk about the consumer being the boss here. So I'm just curious, between now and September, what consumer reports are you really zeroing in on?
Well, we're always looking at things like personal income. We're always looking at retail sales, and we will get some more information on that as well. The reason I talk about the consumer being the boss is because, as we know, it makes up the majority of our GDP. And as you look forward in the year, GDP is expected to slow to below 2% for the third and the fourth quarter. That's likely happening because the consumer is expected to pull back a little bit. That doesn't mean that there's a huge catastrophe coming. It just means that we know the consumer has been pressed by the cumulative effect of inflation, and they've started to pull back on some of that discretionary spending. That's usually the first stuff that gets hit, is the discretionary items. So what you really want to watch is the results from consumer discretionary, but also consumer staples companies. How is their revenue doing? How is the activity in the stores doing? Big box retailers. Those are going to be good tells, I think, this earnings season and in Q3.
And Liz, finally, I want to circle back to earnings because our morning brief chart of the day today looked at reactions this earnings season in stocks versus what we've seen over the past 5 years. And, you know, whether companies beat on earnings and revenue, whether they miss on one and beat on the other, the theme that's constant is that the moves are bigger this time than they have been compared to the 5-year average. We've got this uptick in volatility. What do you think that's a reflection of, and do you think that that's going to continue throughout the remainder of the season?
Yeah, what this chart tells me is that we get rewarded more on the upside, but punished much more on the downside. So punished much more for those surprises in the negative way. I think part of this is a little bit of muscle memory. Investors have been conditioned over multiple quarters that all companies should just beat on earnings. And that has happened for a while. We've had expectations be beat many, many quarters in a row now. So I think we're used to that. We're expecting it. So when we do hear some of these misses, they feel more dramatic because it hasn't happened very much in the past. But it is normal. And especially at a time like this where we don't have a ton of clarity on what the path of rates will be. We don't have clarity on the political environment in the U.S. This is a tough time for businesses to do planning. And it's more likely for them to have some inventory mismanagement issues, maybe overhiring, underhiring, because they're trying to forecast a very murky environment.